In this video, you are going to learn the ideal exit point for swing positions. But on the other hand, if you'd rather fancy learning about the ideal entry point first, I do have a video on that, which I'll link to in the description below. But anyway, since swing positions tend to be a lot more passive as compared to day positions, it's really easy to just set them aside and forget about them like you would aging grandparents. But this is quite simply unacceptable. With every single trade that you make, you need to have a concrete trading plan. That means entry and exit point. So before we get into all of the specifics with all of the examples, I want to go ahead and summarize this from the very beginning so that you don't have an excuse not to have an entry and an exit point plan. Your exit point when it comes to any type of swing position will be at validation. That means, for example, and a recap, we enter at confirmation, which is that first green candlestick opening above the SMA. And then we hold to validation, which is the red candlestick opening or closing below the SMA line. This is simply because being above the blue price strength SMA line means that we're in positive price strength territory. And once we break below it, now we're in negative price strength territory. Pretty intuitive stuff, folks. And this BBBY play was actually a real example from one of our top stock videos from a few weeks ago. However, this was a cookie cutter play, right? And not all plays are going to be so cookie cutter. It's not all peanut butter and chocolate chip, folks. For example, you're also going to get some setups like this. Ones like FedEx that get beat down like the proverbial rabid dog and then completely recover from the overreaction but don't have the same level of clean running up. This is quite ugly, folks. But it's also quite beautiful in that it completely recovered. But in this situation, it's clearly not as simple as just saying, well, buy in at confirmation and sell out at validation. It's just not that simple. Because as you know, just like you can't just randomly buy in at any old confirmation, you can't just sell out at any old validation. If you did that, you really wouldn't be able to take advantage of these types of positions. The dirtiness here means that we have so many different validation points. But the thing that you need to understand is that validation, well, it's not just a point where you say, oh, I'm going to jump ship, but rather a time where you say, does it make sense to exit this position? Think of validation as a question mark. Boop. One that reminds you to analyze your elevating versus your deprecating factors and decide whether or not it makes sense to stay in your position. A lot of the time, you're going to get great setups that look more like 6 where we don't have a perfectly clean run-up and it doesn't correct all the way, but only partially, because while every reaction in the stock market is an overreaction, that doesn't mean that the whole thing was unjustified, right? In this situation, at this point, it's only corrected so far. You had the elevating factor of oversold to increasing and the following run. However, the rest of it was quite dirty, folks. And when it comes to actually taking a position, it's quite simple to clean it up. You just have to change the aggregation period. But once you've already bought into a position, with validation, you can't really do that. If you adjust this to the 5-minute aggregation period, it gets even dirtier with even more validation point. And since at this point we're already in the position, we can't just decide not to take it because we've already executed into it. With confirmation, on the other hand, you could say, oh, well, I don't see any clean running up. I don't see any clean patterns. Then I won't take a position. And that's why the aggregation periods are very helpful. But when it comes to validation, you can't just say, oh, wow, this is too dirty. I'm just not going to take the position. And it doesn't make sense to sell out just because it's dirty either. So how the heck do you figure out when to exit in these types of positions? Well, that's what we're going to be talking about in this video. And the only thing that I ask in return for this video is that you, yes, you, hit that ravishing like button. With FedEx, we get beat down, and then boom, we go from oversold and increasing, and our first clean confirmation is pre-market. If you're taking a position pre-market or after hours, you'll buy in at the elevating factor of having been oversold and increasing. And on the other hand, if you are waiting for market open, you'd have gotten a slightly worse confirmation, but either work. The deal with this is that if you are executing into a position in the pre-market, it needs to be during a period where you have more volume, because otherwise it's just sporadic movements and it doesn't really reflect any actual price changes. So make sure that you have a decent amount of volume. If you're trading pre-market, usually during the last 10 to 15 minutes, it's pretty strong in terms of volume. And just so you know, good enough volume just means that it has a decent amount of volume as compared to where it usually trades during the trading day. So when the market's open, what is the volume trading at? If it's trading at 70% of that volume during the pre-market, well, that's pretty good, right? But the key of this video is to focus on where you exit. And when you buy in with a plan of riding the elevating factors, you're buying in with the plan of riding them until they then become deprecating factors. So hither in this position, your elevating factors are 1, having been part of an overreaction. We know that every reaction in the stock market is an overreaction. Number 2, we're near overreaction lows. Again, if you refer back to number 1, every reaction is an overreaction. So now that we're near overreaction lows, we know that there needs to be a correction. The question though is will it hold at overreaction lows, or is the overreaction going to continue? Number 3, having a price strength confirmation over our blue SMA line. So again, building on the last 2 points, if something gets oversold and it's overreacted, you never just buy sick dogs on the side of the road. You wait for them to show signs of a recovery. And that sign is a confirmation of price strength. So number 4 is you need it to be oversold and increasing. What does that mean? Well, it gets down to oversold and all of a sudden it's now increasing. That means we're not just dealing with a discount, we're dealing with a discount that's now recovering. And these are the elevating factors that would convince us to take a position. So if we're being convinced to take a position by elevating factors, wouldn't it make sense to sell out of a position when those elevating factors now turn into deprecating factors? At validation, we've lost our price strength. We've now been overbought and we've now realized some of the upward potential from the overreaction correction. So that's pretty much effectively flipped all of our elevating factors into deprecating ones. And likewise, we have our first validation point here, and you would have been justified selling there based on that criteria. And I think that a lot of people would look at this and say, oh, but Charlie, you didn't take all of the move. However, being safe in positions means that you are going to have to sell out when your deprecating factors are pulling you out. That doesn't mean that you can't take advantage of further opportunities. With this type of position, you can continue to repeat the process of buying in at confirmation and selling out at validation for as many times as you want and as many opportunities of clean price action that you actually get. But I do think this would be better served with another example. We're going to go ahead and open 6. And now, by the way, these are all opportunities that we've talked about in our top stock videos, so you can go back and see my original analyses on those. Okay, 6 gets beat down like a rabid dog, and you notice it's oversold. You decide to take an entry point around declaration of oversold and increasing, which combined are elevating factors. And then your goal is to ride the price strength up until our elevating factors flip into deprecating ones. Now again, if all of a sudden it turns around, you sell out at validation. However, in this situation, it doesn't turn around. And the next day you decide now is the time to take advantage of this clean confirmation. Your plan is to buy in at confirmation and ride said price strength upwards as we get the overreaction correction. But after a bit of appreciation, you start seeing it sell off. And this is quite common if you don't choose strong entry points. We do get a validation point, but does it make sense to sell here? Is this the correct validation point for this position? Well, if you are attempting to scalp this move and this was your plan in the beginning, then sure. But if you are swing trading a longer term upward potential from oversold, since we know that, every reaction is an overreaction, then it doesn't really make sense to sell out yet. It really depends on your trading plan when you entered the position, and this is why having a plan is so important. But why doesn't it make sense to sell out now? Well, let's go ahead and look at the factors. At this point, we are below fair value, which is a slight elevating factor. We are still near the bottom of an overreaction, elevating factor, and long-term context, we are trading at long-term lows, elevating factor. So it makes sense to hold the position. It's still not a strong position at this point because we do have a validation point, but it doesn't yet make sense to sell out based on the trading plan we set prior. Boom, boom, boom. We continue selling off, and then we get a reversal upward. Similar situation the next day where we ride up and sell off. We get fluked out a bit, but don't get a validation until hither. At this point, we are slightly above fair value on the RSI, but again, checking elevating and deprecating factors and the overall gaining of strength relative to the red directional SMA line would convince us to stay in the position. And then boom, we break into an upward direction, which is an elevating factor, and then sell off. At this validation point, we have just tested and accepted an upward direction. And if you wanted to be overly cautious, sure, you would have been fine and you could have taken your profits here. But the elevating factor of having just tested and accepted an upward direction over our red directional SMA line makes it hard to see that as a rational decision. When you're trading in the stock market, you want to be rational, folks. Holding through this rejection of upward direction and then riding the price strength up would then end you at a fruitful position upon validation here. And if you decided to cut out here at validation, like we talked about a few minutes ago, you would have still been able to buy back in at confirmation and ride the following wave anyways. And your discrepancy with validation points in these situations is really fine as long as you keep your eye out for any other reversals. And this is one thing that I do want to hammer home. Finding exit points is sort of more of an art than it is like an actual science. Being overly cautious probably won't hurt you that much. Like in this situation, you probably missed out on a little bit extra of the move, but if you had your eye on the opportunity, you still would have been able to take advantage of the following run-up, using the same rules that made you cross out of the last one. Okay, so we sell out at validation here. But why would we do that? Because it's at this point where we have not one, but two previous patterns of immediately sinking after being overbought. As you can see here and here, these sunk almost immediately about the amount that they rose, and this time we had a much bigger rise. So we don't want to risk our new gains that we just earned in this confirmation to validation run-up We do not want to risk that on the deprecating factor that is the potential for a new sink. But anyways, you can go really into depth and we can talk all day about entry points and exit points. But this is all glued together by one thing, and it's an understanding of the overall pattern of overreactions. Since every reaction in the stock market is an overreaction, that means that we know that at some point we're going to have an initial correction. Now, it doesn't mean that that correction is going to be very large. It doesn't mean that it's going to sustain. All it means is that we are going to have that initial correction. And if you can understand that, you can understand that buying into price strength will allow you to catch most of the move most of the time. You can understand that buying into price strength will allow you to catch most of the move most of the time. This serves us well because it gives us a stronger basis for playing the entire setup. Okay, another example would be with Sage. Now, Sage is a top loser, and we love top losers. We get oversold and then increasing up to overbought. Boom shakalaka. But a lot of the time this won't be as cut and dry because the only clean area we had was over here. The argument for an overreaction correction here at this point was a lot less strong. And the reason is because the initial overreaction correction in non-market hours took us from overreaction lows at 52.6 and then immediately back up to 73-ish. We had now already established a precedent of establishing overreaction lows quite below the trading price. And the reason this matters is because now we have all of this downward potential and lost steam. We hate losing steam, folks. One of the beauties of overreaction plays is that they have the habit of discounting stocks so much that they obliterate the downward potential. But with the setup, it's already obliterated the downward potential and then given some of it back. So this combines to tell you that we have a deprecating factor that is downward potential and thus need to be extra cautious to take a position at stronger elevating factors. So by this point in the video, I hope that you understand that we sell out at validation, but that not every validation point warrants an exit. Once you get to your validation point, it's a time to ask yourself, does it make sense to exit the position? And if it doesn't make sense though, you have a new problem, right? Which is, where do you exit once you've already gone into negative price strength territory? Well, let's go back to 6. If 6 had decided to continue to sell off at any of these validation points, you'd want to hold until you've broken support. Once you've broken support, that means that we've gone below overreaction lows and we are now no longer in that period of overreaction correcting, but perhaps in a period of a new overreaction. Okay, folks, well, I do hope that this video was valuable to you and that you understand when to exit out of swing positions. If you have any questions whatsoever, feel free to reach out to us in the comment section below or join our free Facebook group, ZipTrader Circle. Also, a quick plug, if you're wondering what broker to trade these stocks on, we always send new folks over to Webull. Webull is offering 2 free stocks for anybody who signs up using our link in the description below, so make sure to take advantage of that. If you do want 2 free stocks, the second stock can be valued up to $1,000. We also have ZipTrader U, which is our premium course for folks who do need that extra guidance in growing their account. If you use coupon code RABBITDOG at checkout, you will get a further discount. Anyways, folks, have a great day, and I'll see you in the next video.